In today's episode, I'll talk about two very interesting stories. In the first story, I'll talk about how and why the US Federal Reserve recently cut interest rates and what it really means for investors like you and me. And in the second story of the day, I'll talk about SEBI's latest board meeting and the new changes that they've made which are applicable to you and me as investors. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 20th of December. Let's begin with the first story, where I'll talk about a big piece of news that came out recently. The Federal Reserve, which is often referred to as the Fed, cut interest rates by 1/4 of percentage points recently. This brings the federal funds rate to a range of 4.25 to 4.5%. Now, to give you some context over here, this is the Fed's third rate cut in a row. And if you add up all the cuts that they've made since they started easing up, it totals a full 1 percentage point. But the thing is, there is a bit of a twist this time around. This was not a usual rate cut. In fact, it was one of the most cautious, or so to speak, hawkish rate cuts in recent times. Now, this might sound a little complicated and even contradictory to some of you, so it's important we analyze this a little deeply. But before we get into the details here, it is very important to get the basics straight for those of you who are new to the markets. See, the Fed controls a key interest rate called the federal funds rate. This rate influences how expensive it is for banks to borrow money from each other. When the Fed raises interest rates, borrowing becomes more and more expensive for everyone, including businesses, consumers, and investors. Now, this slows down economic activity, which in turn helps cool down inflation. But on the flip side, when Fed lowers interest rates, borrowing becomes cheaper, and this encourages spending and investment and gives the economy a boost overall. So the thing is, when the Fed cuts rates, it is usually a sign that they want to support the economy. But this time around, the tone of their message was a little bit different. While announcing their decision, the Fed chairman Jerome Powell said something that caught almost everybody's attention. It was a closer call to cut rates this time, is what he said. He also mentioned that the Fed's policies are now significantly less restrictive. And this means that they have eased financial conditions a lot as compared to they had before. But despite cutting interest rates, Powell did not sound quite optimistic about more rate cuts anytime soon. He emphasized some caution, which sent a very strong signal to the markets. Do not expect us to keep lowering rates like we did earlier. The financial markets, of course, were not happy with this. The S&P 500, which is a major stock market index in the US, fell by nearly 3%, which is, by the way, a very sharp drop for one single day. Treasury yields, which reflect the interest rates on government bonds, also surged. For example, the yield on 2-year and 10-year Treasury bonds jumped by 13 basis points each. By the way, for those of you who do not know, 1 basis point is 1/100th of a percentage point. Now, this kind of spike in bond yields after a Fed meeting is very rare, to give you context. The US dollar, by the way, also strengthened quite significantly. And for context, a stronger US dollar, of course, means that other currencies are weaker in comparison, and this affects global trade and investments as well. Now, interestingly, the odds of another rate cut in January, which some investors were expecting quite heavily, have now dropped to almost zero after the Fed's statement. In fact, the markets are now pricing in very few rate cuts even for the first half of 2025. And this shows just how surprised investors were by the Fed's cautious tone. So the question here is, why is the Fed being so cautious? Look, the Fed's approach seems to be driven by updated forecasts on key economic indicators. Let me break them down for you very quickly. See, the Fed now expects core inflation, which by the way excludes volatile items like food and energy, to be higher than they previously thought. They are projecting that it will hit 2.8% in 2024 and 2.5% by the end of 2025. By the way, this is above their long-term target of 2%. The second thing is economic growth. Now, surprisingly, the Fed raised its GDP growth forecast for 2024 from 2.0% to 2.5%. And this indicates that they see the economy performing better than they expected. The third thing here is unemployment. The Fed revised down their unemployment rate forecast for 2025 from 4.4% to 4.3%. And this suggests that they believe that they can tackle inflation without causing a big spike in job losses, which is a scenario that economists called a soft landing. Now, moving on, one of the most significant takeaways was the Fed's updated dot plot. Now, this is a chart that shows where Fed officials expect interest rates to go in the future. Now, the new projections indicate only two small rate cuts in the year 2025, which is down from four rate cuts that they signaled back in the month of September. Now, this is a big shift for the markets, which had been expecting a much faster pace of rate cuts. As of now, though, investors don't see a full rate cut happening until late 2025. So, this means interest rates are likely to stay higher for much longer. Now, the Fed also made a small technical change. They cut the overnight reverse repo rate, which is a tool that they use to manage short-term interest rates, by about 5 basis points to align it with the lower end of their target range. Chairman Powell emphasized that this was not a policy signal, but it shows how carefully they are managing their toolkit in this new phase. But interestingly, not everyone on the Fed's committee agreed with this rate cut. Cleveland's Fed President Beth Hammock voted against it and preferred to keep interest rates unchanged. And she was not alone in this. Four other Fed officials who did not vote this year also wanted no cut at all. Now, this internal disagreement highlights the tough balancing act that the Fed is currently facing. Powell explained that while the economy is strong right now, the Fed is worried about lingering inflation risks. He noted that while some areas like housing are feeling the pinch of higher rates, broader financial conditions like stock market valuations and corporate bond spreads remain relatively loose. And this layer of disconnect is another reason why Fed could be cautious here. But that said, there is another layer of complexity here. There is fiscal policy under the former and the coming president Donald Trump. Powell acknowledged that some Fed officials are already starting to factor in potential policy effects like tariffs, tax cuts, and immigration restrictions, while some others are not. And this split shows how uncertain the economic outlook is, making it even harder for the Fed to plan. And this brings me to the main question of this story. What does it mean for people like you and me? Let me break it down very simply. First, borrowing costs like home loans or car loans might not drop anytime soon. Second, if you are investing, expect some more market volatility. And third, businesses may face higher costs, which could eventually impact hiring and wages over time. For now though, the Fed is very clearly signaling some caution. They are moving into what Powell called a new phase where they'll be very deliberate about future rate cuts. Now, whether this approach works or not in taming inflation without hurting the economy still remains to be seen. But one thing here is for sure, the Fed is keeping everyone on their toes here. With that, let's move on to the second story and talk about SEBI's recent board meeting. Look, SEBI recently held a board meeting where they announced several changes, 19 updates to be very precise with you. Now, these cover a wide range of areas including mutual funds, IPOs, and even how companies raise money. But don't worry, I will not bore you with all of them. I'll just focus on four main updates that are more relevant and impactful for all of us. See, these changes aim to protect investors, reduce misuse of funds, and create a healthier market environment. What's worth noting out here is that these changes aren't entirely new, so to speak. SEBI had floated these ideas earlier in consultation papers to get feedback from the public. But what is different this time around is that these proposals have officially been turned into rules, and that is why it is important to dive into each update step by step to see what is changing and why it matters. The first change I'll talk about is fixing the SME IPO framework. But before that, what is an SME IPO? See, SMEs, for those of you who are new to the market, stands for small and medium enterprises, basically smaller companies that need funding in order to grow. Now, SEBI had created a special platform for SME IPOs back in 2008 in order to make it easier for these businesses to raise money. The idea was good and the platform grew pretty quickly. Today, there are 745 SME listed companies with a combined market value of 2 lakh crore rupees. But the thing is, this rapid growth came with some problems. Some IPOs showed signs of excessive speculations where retail investors drove up demand for shares of tiny companies with questionable fundamentals. For instance, a small company with just 2 Yamaha showrooms in Gujarat had its IPO oversubscribed by 400 times. Another company called Verenium Cloud allegedly manipulated its IPO to inflate its valuation artificially. Now, all of these examples started to raise red flags. So in order to address these very issues, SEBI started to tighten the rules to ensure that only trustworthy and stable businesses are able to raise money through IPOs. And I'll tell you how. First, companies must now prove that they are stable by showing an operating profit or EBITDA of at least 1 crore rupees in the last 2 of the 3 financial years. This filters out unproven or speculative ventures. Second, companies often raise money for things like expansions or paying off loans, but some of them even misuse these funds or hide their intentions under vague categories like General Corporate Purpose or GCP. SEBI is now capping GCP spending at 15% of the funds raised or 10 crore rupees, whichever is lower. Moreover, IPO money cannot be used to repay the loans of companies' promoters or their related parties. So this ensures funds are used to grow the business genuinely and not for personal gains. Third, promoters and shareholders selling their stakes during the IPO can now only sell up to 50% of their holdings, and this cannot exceed 20% of the issue size. Now, this prevents promoters from cashing out entirely, which leaves the business vulnerable. Fourth, before an IPO goes live, the DRHP will now be open to public feedback for 21 days. This allows investors to raise concerns early, which prevents scams. Fifth one, SMEs can now stay on the SME platform even after raising additional funds, provided that they meet the governance standards. This removes unnecessary barriers for small companies. Now that was all about fixing the IPO framework. Let's now move on to the second change, which is tighter rules for merchant bankers. Look, merchant bankers are behind the scenes players in IPOs and fundraisings. They help companies sell their shares or bonds by managing the process and connecting them with investors. But sometimes their actions lead to conflict of interest. For example, Access Capital, which is a leading merchant banker, was accused of guaranteeing payments, which goes against SEBI rules. To clean things up, SEBI is now enforcing stricter guidelines here. First, merchant bankers, except banks and financial institutions, must now focus only on SEBI-approved activities like IPO management, underwriting, and mergers and acquisitions. Non-core activities like lending and mutual funds must be spun off into separate companies within 2 years. This ensures that their attention is on tasks that they are supposed to handle and not elsewhere. Second, if a merchant banker owns more than 0.1% of a company, it cannot lead or manage that company's IPO. They can still participate in marketing the issue, just not as the lead. The third thing is that merchant bankers are now split into two categories. Category 1 needs 50 crore worth of net worth that can handle all types of issues, including large equity IPOs. And Category 2 requires a 10 crore net worth but cannot manage main board equity IPOs. The fourth guideline that SEBI is enforcing here is risk control in underwriting. Look, merchant bankers now cannot underwrite more than 20 times their liquid net worth. This reduces their exposure to excessive risks. The third change which SEBI brought in and I'll talk about is simplifying the rules for REITs and InvITs. Now, for some context before that, REITs and InvITs are investment vehicles that let people invest in real estate or infrastructure projects, much like mutual funds for property. Now, SEBI's changes here aim to give these very funds more flexibility and make them more safe for investors. There are 4 important points here. First, sponsors, which are the main backers of these funds, must lock in some units to show commitment. Now they can transfer these locked units within their own groups, which allows for better internal management while maintaining their commitment. Second, rising interest rates can hurt REITs or InvITs as they increase borrowing costs. SEBI is now allowing these funds to use derivatives in order to hedge against interest rates. This protects their cash flows and also makes them a lot more stable. Third, InvITs and REITs can now invest in unlisted companies, but only if those companies provide essential services like property management that directly benefit the fund. And fourth, surplus funds can now be parked in the safest liquid mutual funds with low credit risk, which ensures stability and better returns. With that, let's move on to the fourth and the final change I'll be talking about with respect to SEBI's new changes, and that is stricter oversight on mutual funds and NFOs. Now mutual funds have seen a big boom in new fund offers very recently, but this growth has of course brought some set of new problems like distributors pushing unsuitable schemes for higher commissions or fund houses raising more money than they could deploy in the markets. Now, SEBI is bringing in 2 key rules over here. The first rule is that AMCs or asset management companies must now deploy the funds that they raise through NFOs within the first 30 days. In case they fail to do so, investors can withdraw their money without paying any exit loads. Now, this prevents idle funds and also ensures that AMCs only raise what they can use. The second change is all about curbing mis-selling. During NFOs, distributors usually earn higher commissions, which leads to mis-selling. SEBI now mandates that for scheme switches, distributors earn only the lower commission of the 2 schemes. This aligns incentives with investor interests. Now, I know these updates might seem a little technical to some of you, but the thing is, they address some real issues in the market. They aim to make IPOs safer, tighten oversight on intermediaries, provide flexibilities to REITs and InvITs, and also protect mutual fund investors from being misled. By introducing these changes, SEBI is now ensuring that the markets are not only fairer, but also more efficient as well as transparent. So, for all of y'all who are investing in India's capital markets, whether you're a seasoned analyst or just starting out, these updates are a much needed clarity and protection for you. With that, let's move on to the final section of the day and talk about the news tidbits. First, an unusual error inflated India's trade deficit to 37.84 billion US dollars in the month of November due to a double counting of 50 tons of gold imports. Now, this data mishap raises some significant policy concerns because flawed figures can distort fiscal decisions and also lead to misguided economic strategies. Second, the US markets plunged sharply after the Federal Reserve indicated that it might cut interest rates less aggressively in 2025. The Dow Jones dropped by 2.58%, while the Nasdaq dropped by 3.56%. Treasury yields climbed, the US dollar strengthened, and gold prices fell, which reflect tighter financial conditions and heightened investor caution. Third and the final one for the day, Punjab and Sindh Bank successfully raised 3,000 crore rupees through a bond issuance at a coupon rate of 7.74%. This issue saw some great demand and was oversubscribed by 12 times despite tight liquidity in the market. This signals some strong investor confidence in public sector bonds driven by India's focus on infrastructure development and carefully calibrated pricing by issuers. That's all the news and stories I have for you today. I hope you enjoyed the show and found some value in it. I'll see you in Monday's episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.